Data.
Sure. So big data has definitely changed the landscape in underwriting over the last several years. Our company has been using big data since 2017, and it has vastly changed the way that we underwrite our policies, review coverage on applicants. Back, as Aaron suggested, back in the day, 250,000 we could consider with no fluid, so no blood, no urine, standard class at best. Now today, fast forward, we can consider up to $3 million on permanent products up to age 50. So as you can tell, that has completely changed. So then you're asking, well, wait a minute, how is the company able to do that? It's because of this big data. It's because now we have all of this access of the data from, medical facilities, from your pharmaceuticals, big prescription databases. We get all that information up front. We're also scrubbing things like looking at motor vehicle records, and we are also looking at, we can pull criminal history reports. So really, what we're looking to do is just reconcile the information that your client is telling you on the application and answering those questions. We're just looking to reconcile it quickly, because we don't want to have to make your client wait. We know the importance of making sure that you're able to secure that sale quickly, because the longer that it takes the company to make a decision, what does that do for your client? Gives them cold feet, right? Makes them decide, oh, maybe I'm gonna keep that $100 in my pocket. So that is one of the things that has vastly changed in the use of big data.
Laura, kind of piggybacking off what she said, what happens when the information you get from these big data sources, and maybe if you want to get specific on what those are for a second, that'd be great, but what happens when that information doesn't quite match up with the clean sheeted part 2 that you gave? What, as an underwriter, what's your perspective when that happens?
So when we get information from big data and all those sources that Suzanne mentioned, we try to, obviously, we look at the application and see exactly what the client admitted to you. We also compare the different data sources and see if they're lining up to indicate any kind of disclosure. And if that's the case, sometimes we go back to the agent and have you re-question the client to try to get a little bit more information. Sometimes it ends up having to go out and get medical records to decide if that's something that we can still consider. But yeah, the most important thing is getting that information on the application up front, so that when we're getting this data, as she mentioned also, that we can reconcile it, and if we can see that, yes, they admitted their history of diabetes, and we can be as, I don't want to say aggressive, but we can give the best rating available. Yeah, we'll be aggressive. Yeah, we want to give the best rating out the door. And so when everything matches up, we can do that.
Now, Mike, I know you're new, and you haven't had a ton of time maybe to look behind the curtain, etc. However, talk about the difference when you get an application where all the information does match versus, okay, we have some mismatches, as Laura talked about. What does that do for you as an underwriter from just almost like your opinion of not only just the agent, but the application, and especially if they're kind of borderline of, hey, they might be standard, they might be preferred. Talk to us about that a little bit.
Yeah, this is a good question, because it goes beyond just the approach to metric. Now we're just talking about the approach of underwriting. So when an application comes in, you guys do all that hard work, send it into us for review, regardless of the carrier. You're developing a relationship with the underwriter for that piece of paper, that digital application. So the more information that's up front, everything's admitted on that application, and the part 2, at the medical piece. You said icky before, go and describe it. Not those fun conversations with your clients, but all that medical history. The more information we have up front, you build that trust up. So now the underwriter may find a piece of that, and they find something interesting, but hey, it's already addressed in the part 2. Now we have an opportunity where everything's in sync, which is a big history person, by the way, so these all made ones are But now we have an opportunity to look at it and say, you know what, everything aligns, everything looks good, they're being transparent with us. Now I might push that from that standard that I prefer. So I like the case overall. We have all the information we need. Let's go to the flip side, the negative side of that coin, right? You tell us nothing. Now we find all these data sources. Well, now we have that lack of trust. Now that relationship's not starting off on the right foot. And now you have an underwriter who's often curious about what else they don't know. forms, the APS, and the data sources, and the params, and the lives, and all the things we don't want to look at either. So it really comes down to having that information up front, building up that trust in the case and with the advisor, and then taking it from there.
Well, the idea is to minimize back and forth, right?
100%.
That's what you want to avoid. Aaron, we're coming down to you. So, you're welcome to cover big data as it relates to Western Southern. I encourage you to do so and how you guys use that information. But maybe you could take a second and talk about maybe where you see the future of this going. Maybe talk about where it is now, current state, and then if you look into your crystal ball, which I know is kind of hard, but how do you see the use of this data evolving over time?
Yeah, I like to think of, we all have phones and we all know that the things we do on our phones are now being tracked pretty closely by people who want to market to us and sell us things. The same thing's happening in the medical space. There are footprints that you create every time you go to the doctor and every time you have a prescription filled, every time you file a healthcare claim. And those footprints are starting to be accessible to us as underwriters. And that really is what we're going to use in the future to underwrite our clients. And it's, just like Mike said, we want a level of trust with an applicant applies. So when we see an application and we run some of those data sources that are now available to us, some of those digital footprints for medical history, and we see that the history that the client's telling us about matches what we've got from those data sources, we can feel comfortable about it and feel good that we're issuing good risk. And then on the flip side, when it doesn't, we're going to do some digging. But I think we're going to move more and more towards that, finding those digital footprints for your medical history and using that to make an assessment about somebody's health. And when we don't find things, or we find things that are contradictory, then that's when we'll do medical exams. There's always going to be a medical exam required for super high face amounts. I think we've seen companies in the 5 million range, topping out around there, maybe a little higher. But if you're doing $20 million of life insurance, just like a mortgage company is going to do an awful lot of checking before they give somebody a $20 million loan, we're going to do a lot of checking before somebody does a $20 million policy. But for your run-of-the-mill case, $500,000, I see a future where exams may not be a thing. If we can get enough digital footprint on somebody's history, we don't even need that. So I think Columbus Life is looking at a new underwriting engine to make our process much faster. And just the technology from some of the firms out there that are helping underwriters do their job better, it's impressive. And you can really get to a place where you can automate a lot of decisions once you have a really rich digital footprint. You feel comfortable doing that. I think that's where we're headed.
I think all of this, the big data conversation, it's all in an aid or an effort to accelerate underwriting, right? That's the whole point. And I don't know one carrier that hasn't invested in their quote-unquote accelerated underwriting programs. And a lot of these started before the big data stuff started, and they were looking for different ways they could do it, but now with this information that's available, there's all kinds of accelerated underwriting programs that are out there, right? So I think it's important for the audience to hear, one, if you don't mind, a brief summary synopsis of how your accelerated underwriting programs work. But then two, what tips, what advice can you offer to these folks in order to best take advantage of those programs, right? So Aaron, you just spoke, why don't you continue?
So we have a product that we've released in the last year and a half and just recently updated. It's called our IUL Now product. And it's an IUL policy. It's very similar to the regularly underwritten IUL that we sell. It's the goal of the underwriting process is to get as many people through without a medical exam as possible. And right now we're achieving about 70% of our clients are getting an underwriting offer within 1 day of receipt of the application. Sometimes as soon as we receive it in the home office, we're ready to approve. So that's our goal of that product. It was built to accelerate as many processes as possible. It's has a rating class that is slightly more expensive because of that, because we're taking on a little more risk. But at the end of the day, it's a very small impact to the cash value of the policy. And it makes the process faster, it gets you paid faster. That's a really important thing that we're cognizant of. We track submission to commission in Columbus Life, and we want to make sure that we're maximizing that as much as we can. And so I think that's a really nice feature that we can offer at Columbus Life. I would say that, just like we just all talked about, when the data matches what the client tells us, we feel comfortable issuing those risks. And it's, most accelerated programs are going to be just like that. I hate to steal thunder from people that are going to talk after me, but it's going to come down to, does the history you say, and if you don't have any history, and the footprint that we get, the digital history that we get about that client says they don't have anything, well, that's great too. But when someone has a medical problem and they don't tell us about it, then you're going to run into situations where we can't accelerate those risks because we got to figure out what does that risk mean to us as a company.
So for the agent who's doing some field underwriting, what are, I don't know, a handful, a few common conditions you might run across that are going to automatically say, hey, with Columbus Life, this is going to be accelerated?
Cancer is the easy one. Diabetes treated with insulin. That's usually, a lot of companies are getting comfortable with diabetics if they're on oral medication and they're a healthier weight. But an insulin treated diabetes is a sign that they either have type 1 diabetes or maybe a more advanced case of diabetes, a harder to control case if they're using insulin. Those are two of the common ones. The run-of-the-mill stuff, hypertension, a little bit of overweight, mild anxiety or depression, those are things we can accelerate when somebody tells us about it and they've never been hospitalized, they work every day, never been disabled. Those are things that we can look at and get comfortable with those conditions. But the major stuff is heart attacks, another one.
The things you normally
Yeah,
right?
it's normal stuff, yeah.
Just so you guys know, Aaron is actually suffering from some hypertension and mild anxiety right now because he's a little nervous about the Ohio State game tonight.
So are you.
Suzanne, same question. Brief summary of National Line Group's accelerated underwriting programs. What tips, tricks can you offer to make sure that agents take advantage of this program?
Sure. So our accelerated program is called Easy Underwriting. We do have this program that's available on both our permanent products as well as our term. The agents in face amount maximums vary differently between those two products, but like I said earlier, on the permanent product, we will go up to $3 million as a maximum. But once you get over $2 million, that's when we are asking for an APS. So we do ask for one requirement after the $2 million. And then we have a tiered approach where the face amounts do go down as the client ages. As far as this group, I just want to give you a shout out. I happened to look before I came down, and with our organization, our company is accelerating approximately 32% of the business in the last 90 days. So what does that mean? That means a human underwriter is never looking at that case. It's being auto-approved, it's being issued and out the door. Your group, we are accelerating 48%. That is huge, so congratulations. So what that is telling me is that you must have some really good trainers out there in the field, which I love. I also hope...
Hey, that's not supposed to be funny.
And I also hope it's because what we encourage at National Line Group for our underwriters to do is when a case is kicked out, so it lands on a human underwriter's desk to review, we want them to be very clear and explicit with you to explain why we were not able to approve it and why we are changing the decision. So congratulations on those numbers. As far as what are the kickouts, I mean, as Aaron said, I think we're all pretty much going to have probably around the same kickouts. One thing that I would definitely encourage all of you to know, I'm not going to pretend to know how hard it is to go and sit down with a client, stranger at that, take an application and ask all these invasive questions, right? But at the end of the day, I think one thing that I always say, what would I do if I was in your shoes? I would explain that potentially for a minimum amount of dollars that they will give to the company, they could receive, tenfold, quadruple-fold that amount if they suffered a serious medical event or they died unexpectedly. Their beneficiaries would be protected. So that's why the company has to ask these medical questions. Because on the flip side, the insurance companies have to make sure that we are pricing the risk appropriately so that we can also collect the premiums, grow our top line. Why? Because what we're here to do is serve our customers at the end and make sure that we're around to pay those death benefits, pay the living benefit claims. So that's why we're asking those questions. I think most often when you're filling out these e-applications, the questions, like if somebody says, I have high blood pressure, the systems are built so they're going to ask the questions, okay, for how long have you had it? What medications do you take? Do you have any significant, symptoms or issues? So we encourage you to answer those questions, go through them, because the more information that you're able to provide on the application, I'm sure you're sensing a theme, ultimately, the faster that case will go through. And then one last thing I'm gonna say is, I always use, I'm getting older, but if you think about it, we've all seen our doctors. Unfortunately, in America, we love to eat food. We do have some high blood pressure. We tend to have a lot of anxiety and depression. That is okay. That is okay. You could potentially get best class still for your customer. So just assure them that it's just a regular process that, life insurance companies have to do.
Honesty helps, doesn't it? Yeah. Laura, I was involved, Michael and I spoke about a case, maybe a couple weeks before Christmas. Anecdote, there was a target premium case of almost 20,000, it might have been 20,000. It got approved in about 10 minutes. And I think that's wonderful.
That's a great success story.
So, same question as all of them, talk us through your accelerated underwriting program, having additional tips to offer about sharing.
Absolutely. So our accelerated programs start, obviously very small face amounts, even with some medical history like diabetes, and other things not like cancer and heart disease, things like that are going through, and they are going through, with some of those cases without being seen by an underwriter. So we're getting, computer approvals on, even some of those medical histories, even on a rating basis. The system is assigned into rating. So again, if something's not matching up, that's when it gets sent to an underwriter. And the underwriter might have to work through it and see if that's something that we can consider with additional information from you or from medical records. Higher face amounts, we are going up to, currently we're still at $1 million non-medical if everything's matching up. In those higher ranges, we're not giving substandard rates from a computer approval process. So those, if somebody does have things like diabetes, even though they might come out as a standard rating, those are being sent to an underwriter to review. They may not require, any kind of medical records or examine labs. We are using the big data in a lot of instances to try to get the information that we need without having to poke and prod your client. But if your client, I think one thing to keep in mind is if your client does have to go through a medical exam, turn it into a positive. Encourage them, hey, you're getting a free physical. Or by having this medical exam, we're gonna be able to give you better rates, assuming everything's well controlled, of course. But when somebody has some minor medical history and we're not getting any information, we kind of have to assume that it's just average control or be a little bit more on the conservative side with an offer. But when we get medical exams, we get to be as aggressive with an offer as possible. Most diabetics nowadays are well controlled. I mean, it's rare that I see anybody with an A1C over 7 anymore. I mean, it's just insanity. I remember when I first started underwriting 5 years ago, that, we were getting medical records on everybody with high blood pressure. I mean, simple things like high blood pressure or honestly, cholesterol medication, we were getting medical records. I mean, that's just insanity to see how far we've come over the years. And again, going back to big data, I mean, thanks to big data, we can do that. But also, people are taking better care of themselves. And, even if they have some minor medical history, we can still give them really good offers and even better offers when we do have to medically examine them. And one of the conditions I was thinking of to point out that we see pretty often is a kick out or for non-disclosure is like the mild anxiety and depression. Maybe there's a little bit of a stigma And I get that, you know, nobody wants to admit they're depressed. I mean, maybe it makes them look weak, but it's not. And if you can relate to your client and help them, you know, answer those questions, our application is also set up in a way, like Suzanne mentioned, that it's gonna walk you through question by question and help you know how to answer those questions. And if everything matches up, again, you know, we're going up to 1 million computer approvals without even having to be seen by an underwriter. So that was probably the example that you had.
It was,
Yeah.
a funded case, and
Yeah.
it was under $1 million, and
Yeah, fantastic. And in minutes, you know, you can get that approval in minutes or seconds, you know, and it's not having to go to an underwriter. So as long as that information matches up.
it made some agents stay out here.
I bet. I'll bet.
Mike, I know you haven't been with Symetra long, but hopefully long enough to get an understanding of how the accelerated underwriting programs work at Symetra. Same question, walk us through how it works at Symetra, any tips, tricks that you have?
It's been long enough to get good at high level overview. No, so at Symetra, we have two great options for accelerated underwriting. One is an accelerated program through our core business. I'm not going to get too into details on that today. What I do want to focus on is our bigger one, which is our Swift business, our Swift platform. Hopefully many of you are familiar with it. That is a true automation platform, and you can do business up to $5 million, depending upon the product, depending upon the age of the client, depending upon the health of the client. If you want the exact specifics, come see us during one of the breakouts, I'd be happy to give you those. But what's beautiful about Swift, the similar what we're hearing here, is the clients have a whole lot of paths. You can get that instant decision right away. An advisor was kind enough to share her story. I didn't threaten to bring her up here, I will not do that. But she did share a story this morning. We're sitting at the table with one of her clients going through the process, they ping on their phone, she said, no, now it's your turn to do your part. They did their part, a few minutes later, there's a ping and there's a decision, they're approved. So we have that path. And then you also have the ability to take it a step further. So maybe it does get kicked out for a particular reason. We'll go to one of our underwriters and they'll navigate the process from there. So overall, it's called Swift, it's too easy, but it is called Swift. It's a Swift experience. It does give you the opportunity to go all the different paths with your client. One thing I want to call out that's been touched on a few times up here is how do you set those expectations? We all know that sometimes big data is going to turn up something, or we're going to find something on the history that maybe we thought was okay, when it gets to us, the system doesn't quite like it. And to that degree, I would encourage you to set those expectations with your clients. Say, hey, here's the process we're laying out. You're in good health, good shot, you go right through, but if not, here's how we're going to approach it, here's how we're going to handle it, here's the things that you may want to do. And by doing that, you're putting them at ease, and you give them the opportunity to know what's coming at them and work that process with you. And naturally, we want that instant approval, we want to go through nice and easy for you. But set the expectations with them, so if there is additional information needed, they're ready for it, they can help us do it, we can set the overall experience fast.
Wonderful, thank you. Many of you in here, maybe not many, but some of you in here have met my wife, Jamie, and she actually bought a Swift policy when Symetra was coming on board. They needed a guinea pig, and my wife needed more life insurance, so it was just a match made. And she was approved the same day for, I think it was $750,000 worth of coverage. Now, she's healthy and all that kind of stuff, but for those types of clients, those programs, that's not just with Symetra, but all those programs are available. I want to kind of change gears a little bit. Quick show of hands, who has been with FFS or maybe in the life insurance business for 2 years or less? Show of hands. We have a lot of newer agents in the crowd, so this question is for you. But for you experienced agents, you'll get something out of this as well, I think. I want to, again, I don't do math in front of people. We have a lot of years of experience, right? So sometimes, and I'm guilty of this myself, being almost 20 years in the business, I want us all to take a step back and look at this through the lens of a new agent, or maybe an agent that just doesn't have a ton of experience. What would you tell them? What tips, advice, in order to make underwriting as painless as possible, and particularly to eliminate that back and forth, right? Because that's the part, I don't know about you, but that's the part that really irritates me, is when you're going back and forth all the time with a company. For those newer agents, what advice would you give them to make underwriting as painless and as seamless as possible? We started down there, we'll start with you, Mike.
So this one's timely, and I'll tell you why in a moment, but I'm going to start off with the general advice, which is, again, as I mentioned before, setting expectations with them. Let them know what's going to happen through this process and possible if and ands. Okay, give them the heads up. Life insurance is not easy. That's what we've been talking about quite a bit. We're trying to make it easier. So set those expectations ahead of time to make it a little better for them. But then keep the line of communication open. Let them know where they're at in their process of underwriting. I'm still shocked by how much this is not happening. And when I was saying the timing and the recency of it, a good friend of mine knows what I do for a living to some degree. He was getting life insurance for him and his wife. And we just talked 2 or 3 days ago. He was going through CARA, I'm not going to mention right now. No one, these people are all fantastic. This would never happen in these times. And he had a high-end advisor. It was a big case for both him and his wife. They literally reallocated a lot of assets into it. And he talked to me ahead of time, which I'd be prepared for. We talked about his health, and we talked more about his wife's health. His wife has some challenges, some cancer history, some other things. And I said, well, just to be weary, like, this may not go through the way you think it's going to go through. I know your advisor's telling you one thing, but here's my perspective. Here's some things to prepare for, here's some things to work on. And the whole time it was going on, he got approved in a few weeks, which is still a few weeks, way too long. And then I kept asking about his wife. I kept asking about his wife. He said, no, but I'm being told by the company it's going well. There should be a few more ways to get more information, get more information, get more information. Okay. But he was trusting it was going to happen because they implied it was going to happen. He was trusting it was going to happen to the point where he canceled her group life insurance coverage. He trusted to the point where he did have to reallocate assets to get her set up. I think you all know where this is going. So 4 or 5 days ago, she was offered the coverage at a higher rate, like his friend told him. But it was missing many of the elements of the policy that they really needed to make it effective for him. So my question to him was, I'm trying to do very hard not to use his name. I said, did your advisor keep you posted on this? I haven't talked to him since I met them for the initial part of the sale. I said, has the carrier explained to you that she's at least going to be a higher risk class and this outcome might happen? No. I said, well, all right. So you need to talk to your advisor and you need to explain to him what happened because of all that. So anyway, that's my long-winded way of saying set those expectations and keep them posted. Underwriters are truly your partners. No matter what the carrier is, whether you go to an underwriter or a case manager, they know the status of your case. They know how it's trending. It's a metro. I'll speak for us. We're going to tell you, thank you for the opportunity to get more information. By the way, I know you're going preferred. Well, with Parkinson's, this could be substandard game. So set that expectation in mind before we go down this road. We still want to give our options, whatever the case may be. So set those expectations, keep them aware throughout the process. So like we're having my it just makes everyone look bad.
Well, so, Laura, what would you say? What would you tell a new agent getting started? How should they best work with underwriting?
So I love the setting the expectations. I mean, that's the biggest thing for sure. And I know we have, I'm sure everybody else here has, an avenue where you can submit a question or a quick quote to get a tentative rating ahead of time. So, we have an email box. You can just send it, hey, I got a guy. Here's his medical history. Here's what medications he's taking, his age, smoking status, things like that. How should I rate them? And that way, you're going to the client and you're saying, okay, managing those expectations. This could be a table, F. And at that point, these benefits would not be available. That was such a great point. Like if they're looking for accelerated benefits, they might not be available at that mark. So getting those tentative rates ahead of time, and then working with your client to see what is their goal for that policy. Is it for accelerated benefits? Is it for a death benefit? And managing those expectations ahead of time, because you and I both know that you voted a preferred or even a standard, and we come back with a substandard rating, that now you're going to have to resell that policy. It's no longer an easy, okay, here's what you were expecting, have a nice day. It's, here's this higher premium, do you still want it? They probably don't. I mean, it's just a harder sell to go back like that. So preparing your client ahead of time, and again, with the examinations, that's the same thing. Preparing your client ahead of time that, okay, this very well may go through on an accelerated basis, but there's a chance that your medical history may require examination, and if so, we'll have an examiner contact you to schedule a time and a date that works for you, and we'll get you the best rates that you otherwise qualify.
Suzanne, what would you tell a new agent?
Aside from setting expectations, I think that I would tell the agent that the normal healthy population, that means your standard. Just your average, and at any given age, if you're otherwise healthy, you have some minor things going on, maybe it is the high blood pressure and diabetes controlled by medication, by oral medication, not insulin, then you're probably standard. And I would say go ahead and quote that, because what that means is the client is expected to live their average life expectancy, which is a great thing. Now, let the insurance company review all of this data that's coming in, look at the application, and go offer you preferred. Because then what happens is you come out looking like a hero. So I think that would be my biggest piece of advice is really try your best to refrain from quoting the best preferred classes. Because remember, I would say it's probably a little more than 80% of customers are going to be standard rates. But then every insurance company has different tiers and we have different preferred rates. So that's one piece of advice I would give. I think the other piece of advice that I would give is go through the application questions. Again, I was saying before, it is definitely, that's an invasive process. We get it. But that's why the carriers are working so hard to not have to then go back and stick them with a needle, have them pee in a cup. So just explain, we're having you answer these questions so that the carrier can provide you the best rate. Because if they're doing that, then they are actually getting the rate that they deserve, which is fantastic, versus just lumping them into maybe a substandard rate class. So that's another piece of advice I would give. I think the last piece of advice I would give for our company, and I'm sure everybody else up here, they do the same thing. We spend an awful lot of time updating our agent guide, so it's a field underwriting guide. We update this, I would say minimum 3 times a year, but it could definitely be more. I really encourage you to save that guide in your web browser on the agent portal, just so you have quick access, because that's really where you're going to understand, oh, okay, for National Life Group, I know that here's the list of problematic medical conditions. So maybe I won't submit that application, or maybe that's time for me to use National Life Group's quoting tool. So we have one that's called X-Ray. It is an online tool. As much information as you provide into it, the tighter risk assessment we will be able to give. But if you only have a couple of pieces of information that you want to put, that's okay as well. If it's something that this automated underwriting quote tool cannot assess, it will pick out anything the underwriter will. So I think that's what I would say for my advice.
Yeah, for those of you just getting started, there's no reason to change the illustration from standard to super preferred. Don't do it. Just don't do it. Aaron. Yeah. You'll learn from our
Super preferred.
Aaron, you've been quiet down there. What advice would you give for this?
So I like to keep things simple, and I think an acronym is a good way to do it. So for new agents, when I do these talks, I use the acronym LACE, L-A-C. L, learn the underwriting process and the products that you're selling. So when you're equipped as an agent with that knowledge, you can put your clients in a process or a product that will best fit their needs and their desires and their expectations of what the underwriting process will look like. So L for learn the underwriting process. A is, we've talked about this, accurately answer the medical questions on the application. That helps things go faster. C is communicate. Communicate with the underwriting department is how I use it. We do not see your clients as underwriters. The only thing we see about your clients is what you tell us in an application or those digital footprints that we get from your client. So if your client is a marathon runner, and that's not a question in the application, it could be really pertinent to their medical history and a good positive fact that you want to tell us. But if you didn't communicate that on the application or in a cover letter, you will never know it as underwriters. If they had surgery 4 years ago, and since that time they've stopped smoking, they've lost weight, they've now taken up an exercise regimen, that's an opportunity for you with somebody who has had complicated history, to share those positive facts with the underwriters. So communicate the good stuff to the underwriters, communicate stuff that's important, that you think is important to the risk that we're going to consider, because if you don't, as producers, if it's not showing up on that application, we probably won't know. So there are some digital footprints that just don't exist, and you can help us with that. So C for communicate. E is expectations. We talked about that. Set expectations with your clients. If you do the L well, you'll know how long the process will take. You'll know roughly that you have a good chance of not going through an exam, or maybe you'll put in a product that doesn't have an exam. Or that there may be a possibility of an exam, you can communicate that. And if we're getting medical records, if there's a case that's complicated, you're setting expectations that medical records can take some time. Client, here's how long it would typically take for a medical record to be done, or an exam to be done, or whatever it is. If you're informing your client about that process, it helps. So LACE, learn, accurately convey, communicate, and set expectations.
I like acronyms. I use them all the time. I want to get a little specific here. Changing topics a little bit. At FFS, we love kids. We love kids. Some of our agents have like 9 kids. But we also write a lot of juvenile life insurance policies, a lot of them. And it's surprising to me that at times I get calls where people are having issues with underwriting juvenile policies. Now, there's some obvious things that are going to require a little more underwriting, conditions, things like that. But all kinds of different issues that can pop up from a juvenile standpoint. So why don't we start with, Laura, if you don't mind, why don't you start with just financial considerations? How do you look at, okay, you get an application, there's $500,000 in coverage on this 1-year-old. How do you look at that? What do you need to see in order to even continue the underwriting process?
Excellent question. So at American National, we have actually recently, in the last couple of years, I think, liberalized our guidelines a little bit when it comes to juvenile consideration, where we now only require a single parent, one of 2 parents, to have at least equal coverage on themselves as they are applying on the child. We realize that, especially with IULs, it's definitely looked upon as a financial vehicle. But for an underwriter, it's still a death benefit, and we're still very, very careful with the amount of coverage that we're willing to place on a child's life. So we definitely look at what coverage the parents have. We like to see that all siblings are insured equally, or if not exactly equally, soft for premiums. We have some wiggle room on that. But at the younger ages, less than 1, I think we're a little bit more diligent with getting medical records on face amounts, I think exceeding like $150,000. But the older kids, most kids are in great health, and that's fantastic. It's a great opportunity to seal in their insurability at a young age and get that endorsed. So I think it's a great tool. It's a great vehicle for those kids. But we do want to ensure that there's no nefarious intentions going on, and that the children are safe and protected with such a great tool under their belt, if you will. I'm trying to think of what else we're doing with kids. I think that's
Most important to avoid those mafia schemes, right?
absolutely.
Suzanne, same question with financial consideration, but also maybe walk us through what you're thinking when you see a juvenile policy and the owner and/or payer is not mom or dad. Because we do get this situation sometimes where someone other than mom or dad wants to buy a policy. What goes through your thoughts, and how can they actually get that approved?
Absolutely. So first I'll just touch upon National Life Group's rules. So it's kind of similar to what Laura just explained, but one thing that I feel is different is we will allow up to $500,000 in coverage on a child, and that is regardless of whether or not a parent has coverage in force. So we do really need it. This was a rule that was changed, I believe, about mid-summer. why we got comfortable in doing that is because we do, we track our policies, we follow them. We do really believe that is, it's a safe zone for the company. As Laura said, your children, they're healthy, right? And it is really important to secure that insurability when they are young. For face amounts that are exceed 500,000, so 500,000 and a dollar up to 1 million, that's when we do require that the breadwinning parent has to have coverage in force, and we will consider up to 50% of that coverage.
Shirley can't wait. Just can't wait. Shirley, can we come back in just a minute?
And then for face amounts that are over $1 million, we are always going to require an APS. And where National Life Group caps the face amount for a juvenile is, we really have a hard time getting a need if that face amount gets much above the 2 million. So 3 million is where we're like, oh, we really got to see what's going on here. It's not to say we will never do it, but that parent must have a really large estate need. Okay, so that's where our rules are. As far as financial considerations and what do we consider when we see other people applying for the coverage. So we have to keep in mind, first and foremost, this is a death benefit, right? It's life insurance. And so what does that mean? It means that if that child dies, the beneficiary is going to receive those proceeds. What we want to make sure does not happen is that a windfall happens to whoever is the beneficiary. And a windfall means that there was really no need for this exuberant amount of money, and that money is all of a sudden going to just create instant wealth for that beneficiary. And that's whether it's the parent, a grandparent, etc. So that's one thing to keep in mind. Now, another thing is if we see an aunt or an uncle who is interested, that's going to make us probe deeper. What we're going to want to understand is why is auntie and uncle going to take up this application? Is it because mom and dad are not in the picture? And if that is the case, we might be able to consider, but we need to see that aunt and uncle have guardianship of that child, and we will ask for proof of documentation. A grandparent absolutely can take out coverage on a child. I'm not sure if that's the same for, okay, I'm seeing a lot of head nodding, but we'll allow that. But what we do want to make sure is that you still receive the okay from the parent, and so we do require that parental signature on the application. As far as premium, I can't say that we see this often, but definitely in my time I have. What causes concern, when we look at this, it doesn't matter what age the applicant is. If somebody else is paying the premium, who is not the owner, we're going to figure out what's going on. Why do they want to do that? It might be all on the up and up, but that's when we're going to ask questions. So that's when we would like you to please provide us that information up front. Just be honest. Let us know what the ultimate goal of this policy is.
Thank you. Aaron, I know Columbus Life writes some juvenile policies. Can you walk us through how, from an underwriting perspective, you look at financial consideration, ownership structure for kids?
We're not terribly different than what we've heard. I think our rules are we will allow 50% or 100% of the parent up to 500,000, and beyond that it's 50% of the parent, and that all children are treated equally, either by face amount or by premium. If you're doing $100 per kid and they're all different ages, that's going to create a different face amount, and we understand that. That's a perfectly acceptable situation. This goes back to the communication part of this last point. When you're not doing a mom and dad sale, mom and dad buying their kids is perfectly normal. It's the other situations. Communicating with the underwriter what the intention of the policy is, what the purpose of the policy is important. We as underwriters have a legal responsibility to issue policies where there's an insurable interest, where there's not a windfall created. That is actually in many states an actual legal requirement for us to issue policies. And so if it's an aunt and uncle, we're getting really nervous about this situation, and if there's not a guardianship type relationship, that's probably a windfall situation that we legally can't do as underwriters. But when there's a guardianship situation, it's more of a parental relationship than aunt and uncle. That's where we consider, and that's where we need you to tell us. that that's happening. And it'll help the process go a lot smoother if you're upfront about it and let us know where it's going. Other than that, yeah, I think we're all talking pretty industry's typical language up here, so you'll see this probably at every company, some iteration of these rules.
Yeah, well, thank you. And I don't want to exclude Symetra from the conversation. But for those of you who don't know now, today, they don't underwrite juveniles. However, I've had a number of meetings with Symetra. I've been involved in some of their advisory boards that they have with different distribution partners, and I made it abundantly clear to them, all the way up to, I don't even know what her title is, Mindy. I don't know what is it called, these titles?
Minnie's the head of life.
So Mindy's the head of life. I had dinner with her one night, and I said, if you want to grow business with us, you need to underwrite juveniles. And so I think that message has been heard loud and clear. Anything you want to add?
Just got lectured. No, I'll answer that, right? So that's the beautiful thing about being handicapped. You come in, you hear about these concerns. You hear about the areas where we're not playing as well as we should be playing or should be playing. And my experience is pretty good in juveniles, so no, that is something we are going to focus on in the new year. My list is, of course, growing. Every day I spend at Symetra, it's getting longer and longer. But juveniles are certainly in the top. So hopefully by the time we all meet next year, maybe we'll have some better news for you on that front. I don't want to miss an opportunity to educate. So I do want to add one more piece to this. We've all touched on what our companies can do. We touched a little bit on what we can legally do and not do. I want to build on that for just 1 second for all of you. When it comes to juvenile coverage, the states love to get involved. So the state insurance commissions dictate a good amount of what a lot of us can do from our guidance standpoint, how much we can offer and who we can offer it to. That's my nice way of saying we have to deal with that behind the scenes. So it'd be nice to underwriter when they sometimes cap you at a certain number or explain what I can't really want to do. But again, Symetra, not in a space we're in terribly at this moment, but we'll revisit that hopefully better news for you next year.
Mike, I'm the son of a school teacher, so just in my blood to lecture.
You're very kind.
Yeah, thank you.
Mike, can I just say, I appreciate you calling that out. That is definitely that's a huge miss, I think, on my part, because we do have products that are available for sale in all 50 states. New York, those guidelines that I was telling you earlier, absolutely do not, are not approved, right? And you guys all know that. I've seen you shake your head, just like they have guidelines for every other thing that you do for a life insurance product, but thank you, appreciate that.
I want to stay on the kids for just a second, because there are certain maladies, we'll say, that tend to affect kids more than adults. Things, ADHD, not necessarily more than adults, but mental health issues, things like that. Maybe we can just go through a couple of those and just kind of rapid fire. How do you view those? What information do they need to communicate to you, the underwriter, when those types of conditions come up? So let's start with ADHD. How does anecdote, for example, if you get an application for an 8-year-old and they have ADHD, how do you view that?
Well, it's funny you mention age 8, because we actually don't cover any children with ADHD until they're at least age 9. So once they're age 9, we can take a look at them. And most are going to go through, and they're going to go through with, pretty favorable decision. Those are not going to be a big deal. Now, if you have ADHD in combination with any other mood disorder in a child, children, bless their hearts, I'm from the South. You just don't know how these kids are going to react and how they're going to respond to mental health concerns. So, ADHD, while that is insurable for us at age 9, when it comes to other things like, depression and anxiety, we most of the time prefer to wait until they're a little bit older before we offer consideration on those. So we are going to get that for us.
When you say older, you mean 20?
Maybe.
Yeah.
And
Young adults.
Yeah, because you want to see them go through the hard parts of life. Age 8, 9. I mean, that could be tough, but go through puberty. And these kids, and they're going to go through stressors in school and college. So you want to make sure that they're able to handle life before we start insuring.
While you still have the money, what about childhood diabetes?
While childhood diabetes, obviously there's still type 2 in children. I think everybody just assumes a child's type 1.
Right.
But, they're, unfortunately in our day and age, and with obesity trends on their way up, there are many children that have type 2 diabetes. Unfortunately, for American National, all of our products don't support ratings over a table 4. So we are unable to issue coverage on a diabetic until at least age 18, where our products can accommodate the higher ratings.
Suzanne, what about some of the conditions that tend to affect children more, ADHD, maybe even, one that comes up a lot, autism, we didn't touch on that.
Oh, sure. So I would say that National Life Group's rules and philosophy are very similar to Annaco's, and at the juvenile ages. So as she stated, up to the age of 18. For autism, we are actually seeing a lot of files come in with autism, not admitted though on the application. Where we're learning this is from the big data. And, as a child is really young, like sometimes we'll see autism diagnosis at age 2. That's really hard, right? Because it could be, it may not be, maybe it's something else, maybe it's just slow growth, maybe it's like not meeting their milestones in the proper way, but it might not be overt autism, maybe they're on the spectrum, etc. So for all of those reasons, we've made the decision that it's really hard to assess a child with autism who is under the age of 8. So once they are 8 and above, we will consider the file, but we will order medical records. We will assess and see how are they functioning in school. What are their medications they need to take? Do they have individual education plans in place? So there are definitely things that we can look at. But as Laura stated, we are not going to be aggressive if we find that maybe they're in a postponement period. So if we cannot approve a case within 4 tables, we too would also say, I'm sorry, we need to walk away at this point. But it doesn't mean that they're insurable forever. So just know that once they get through the puberty and the hormone stage, all of that, that's when all of these mental health conditions tend to start to level off. But we are seeing more and more of these mental health issues in this third party, and I'm sure that's probably why this question is being asked. And I know for our company, we're trying to figure out, frankly, how to deal with it. Because there's not a lot of great documentation, even if we get medical records. And I think every physician is treating it differently. So we do our best, but we're definitely making sure that those children are healthy, doing well in school, not having angry outbursts, etc. So those are the type of traits we look for.
Thank you. Aaron, same question. When you think about those types of maladies that tend to affect children more, how does Columbus Life view those?
I think I can count on one hand, maybe 2. The number of children's cases we rate. It's just not very common that we, in general, with healthy children, they're either healthy or they're uninsurable. There's not a whole lot in between. It's kind of a weird conundrum with children. But on autism, we're almost identical to what's been said. At 8, I think we start to consider, and we're really looking for how autism is a spectrum. So our most favorable ratings will be for the people on the light symptom side of the spectrum, and the people who will never develop independence, who will have someone that's caring for them their whole life, who have very severe autism, those will be hard to insure. So that's how we look at it in Columbus Life. Juvenile diabetes, will the same. We don't consider until they're children or until they're 18, until they're not children anymore, excuse me. And then, childhood cancers are really tough. We don't consider those. The most common heart problem we see in children is a small hole in the heart, called a ventral septal defect. That's probably the major heart problem that we can insure for children. Most kids grow out of it, and if they don't, the surgery is usually very successful, and those are the ones that we can insure a couple years after the surgery once we know that everything's good. But children are pretty easy because most of them are healthy, which is why underwriters like them, because you look at it, you approve it, and you move on to the next case.
So to summarize, generally, some mental issues going on, you're probably gonna wait until a young adult. If ADHD, maybe a teenage years in that realm. Is that fair?
It's definitely all individual cases.
Yeah.
It's going to depend on what do we know about the medications, how long have they, been diagnosed with this, what is those third-party data sources telling us. So really, it's not one size fits all, unfortunately. I wouldn't feel comfortable saying for every child who has ADHD, we could do X. I just wouldn't.
Sure, that's fair.
I'll give you a tip. My boss taught me this. If you've got a kid that you're really trying to, if someone's on the fence about, or an underwriter's, a little concerned about it, get a copy of that grade card. If an underwriter can see that you've got a kid that's getting A's and B's in class and is taking algebra and calculus, all the hard stuff that you would see, that's a really good sign for us as underwriters that, hey, we've got a pretty successful kid that's able to cope and is doing well in school. So it's a really kind of unique thing that you can help the underwriter get comfortable with by showing them how successful they are in school. Now if it's D's and F's, maybe don't send it to us.
Good tip, thank you. Well, look, we've covered a lot. Talked about big data, talked about how you use it, what it means, talked about advice for new agents, talked about working with kids, a lot of juvenile business. It is a rare opportunity that you get 4 major underwriters, chief underwriters, managing directors of underwriting on stage. So I want to say we have about 20 minutes before lunch. So I want to open it up to questions from the audience. But Shirley will get to go first. She's so kind, she's so patient, and if you know Shirley, she's not that patient. But I want to open up the questions. There's some ground rules. What we're not going to do, what I'm going to ask you not to do, is raise your hand and say, I submitted a case last month and X, Y, and Z happened. Because these underwriters from the stage can't fix X, Y, and Z last month.